Hello class and welcome to Chapter 16, Cost Allocation, Joint Product and Byproducts. In this chapter, we are going to be looking at several different objectives. They include identifying the split-off point in a joint cost situation and distinguishing between joint products from byproducts, explain why joint costs are allocated to individual products, allocate joint costs using 4 different methods, identify situations where the sales value at spin-off point is preferred when allocating costs, explain why costs are irrelevant in a sell or process further decisions, and account for byproducts using 2 different methods. Some of the terminology that you will need to use in this session include joint costs, which are the costs of a production process that yield multiple products simultaneously. The split-off point, which is the juncture in a joint production process where 2 or more products become separately identifiable. Separable costs, which are all costs incurred beyond the split-off point that are assignable to each of the specific products identified at the split-off point. We have 2 categories of joint process outputs, which include the outputs with the positive cell values and the outputs with 0 cell values. We also have product, which is any output with a positive cell value or an output that enables a firm to avoid incurring costs. Cell value can be high or low. We have the main product, which is output of a joint production process that yields one product with a high sales value compared to the sales value of other outputs. And then we have joint products, which are outputs of a joint production process that yields 2 or more products with high sales value compared to the sales values of other outputs. We also have byproducts. The byproducts are outputs of a joint production process that have low sales values compared to sale values of other outputs. Distinctions between main products, joint products, and byproducts are not so clear-cut in practice. Companies use different thresholds to determine whether the relative sales values of a product is high enough for it to be considered a joint product. This is the example 16.-1 on page 634 of your book. So it talks about the different industries and the separable products at the split-off point. So an example with cocoa beans, separable products with cocoa beans would be cocoa butter, cocoa powder, cocoa mixed drink or drink mix, and tanning cream. For coal, we have coke, gas, benzoyl, tar, and ammonia. We have crude oil, which can be made into gasoline, kerosene, benzene, and naphtha. And then a fabrication of silicon wafer chips, memory chips of different quality, such as capacity, speed, life expectancy, and temperature tolerance. So I would definitely review all these to get an idea of what they're talking about. We have the raw material basically, and then how can we make that add to different products. Before a manager is able to allocate joint costs, he or she must first look at the context for doing so. Joint costs must be allocated to individual products or services for several purposes, including computation of inventoriable costs and cost of goods sold for financial accounting and tax reporting, reimbursing companies that have some product reimbursement under cost-plus contracts, and regulating the rates of prices of one or more of the jointly produced products, and of course, litigation or insurance settlement situations. We have 2 different approaches to allocating joint costs. The first one is market-based, which allocates using the market derivative data or dollars. They do it based on sell value at split off, net realizable value, and constant gross margin percentage, or NRV. The second way we do this is through physical measures, which allocate using tangible attributes of the product, such as pounds, gallons, barrels, and so on. In preceding chapters, we use the cost and effect and benefit received criteria for guiding cost allocation decisions. Joint costs do not have a cause and effect relationship with individual products because the production process simultaneously yields multiple products. Using the benefit received criterion leads to a preference for methods under approach 1 because revenues in general are a better indicator of benefits received than physical measures. Here, this particular exhibit is on page 637 of your book. It is a pictorial view of joint costs. In this case, we are looking at the production of raw milk into cream and liquid skim. So according to this, we have joint cost of $400,000, and that is from 110,000 gallons of raw milk, from the point it is taken from the cow to through the processing. And then we have, at that point, we have split it up. We make 25,000 gallons of cream, and liquid skim is 75,000. So the costs involved are the 400,000 that would be allocated between the two, and then any cost beyond the split off point would be allocated to the particular item that it produced. So in this case, if we have the information. Again, joint cost of 400,000. And then with cream, we have 25,000 gallons of production. We sold 20,000, and we have an ending inventory of 5,000. So how did we get that $8,000 per gallon? The selling price per gallon. That's how much they sold it for. Then we have the skim milk. We have production of 75,000 units or gallons. We have sales of 30,000. So we still have in inventory $45,000 or 45,000 gallons of milk. And they are going to sell this for $4. The sales values at split-off method allocates joint costs to joint products produced during the accounting period on the basis of the relative total sale value at the split-off point. This method uses the sale value of the entire production of the accounting period, not just the quantity sold. The sales value split-off method follows the benefit received criteria of cost allocation. So this is how we break it down. In this example, we use the sales value of total production at split off to determine the cream is 40% and liquid skim is 60%. Those percentages are then used to allocate the joint costs. So if you take the 25,000 and the 75,000, and that's how they get the 40-60 split. How they get the 40-60 split is actually through the sales. Cream had 20,000, liquid skim had 30,000. So 20,000 of 50,000 is 40%. And liquid skim, which is 30,000, if you take 30,000 divided by the 50,000 of total sales, you get 60%. So how do we get the sales value? So we got 25,000 at $8 per gallon, and that's 200,000. We have 75,000 gallons at $4 per gallon, and that gives us 300,000. That's the value of the total production. So we had production of 100,000 gallons. and we could possibly bring 500,000. Now, weighing it, basically what we do is take the 200 divided by the 500,000 and get 40%. We have the 300,000 divided by 500,000. We get 60%. We take the 200 times the 40, the 400,000, which is the total cost. For 40% of 400,000 is 160,000. And then 60% of 400,000, the joint cost is 240,000. So that's how we get the allocation. So then get the joint cost per gallon. We take the 600,000 divided by 25,000. So we get $6.40 per gallon. Take the 240 divided by 300,000. I'm sorry, take the 240 divided by 75,000, and I get the $3.20. Now, revenues, the actual revenues that we have, we take the actual sales, 220,000, and we take 30,000, and we get 160 for the cream, and we get 120 for the skim. And then the total cost, which we bring up from above. So joint cost, we're going to allocate that 160 and 240 to allocate the full 400. Deduct the ending inventory. So we had 5,000 gallons of the cream left over. So we're going to take that times the cost per gallon of $6.40. And then we take the 45,000 gallons of liquid skim, multiply that by $3.20, and we get the 144,000. Subtract that from production costs. So my cost of goods sold of the joint cost is 128,000 for the cream and 96,000 for the liquid skim. My gross margin is $32,000. How do I get that? I take the 160 minus the 128, I get 32,000. I take the 120 minus the 96, and I get 24,000. So my gross margin for everything is 56,000. Gross margin percentage, I take the 32 divided by my revenues, and I get 20%. Same with the liquid skim. We take the 24 divided by 120, and we get 20%. The physical measure method allocates joint costs to joint products produced during the accounting period based on the basis of a comparable physical measure, such as the relative rate, quantity, or volume at the split-off point. In this example, we have the physical measure of total gallons produced of 25,000 and 75,000, which is 25% and 75%, or 0.25 and 0.75. Now, we take those two numbers, the 0.25, multiply it by 400,000, and that's how I get the 100,000. We take the 75.75, multiply 400,000, and I get 300,000. So then what do? Is I take the 100 divided by the total number of production of 25,000, I get $4 per unit. Take the 300 divided by the 75,000, and I get $4 per unit. Then we do basically the same thing as before. We have the revenues of the actual ones sold of 20,000 and 30,000 gallons. Take each one times their respective revenue cost per unit, or sales per unit of $8 and $4. So that doesn't change. What changes is the cost of goods sold. We're going to take 25% of the 400,000, give it to cream, and 75% of the 400,000 and give it to the liquid skim. Now, deducting our ending inventory for the cream was 5,000 gallons. I'm going to multiply it by the $4 I got for the joint production cost per gallon. I take that 5,000 times 4, I get 20,000. My cost of goods sold is 80,000. My gross margin is 80,000. I take the 160 minus the 80, and I get 80,000. Take that 80,000, divide by 160, and that's how I get the gross margin percentage. Now, for the cream, or the liquid skim, same process. I have 45,000 gallons at $4 per gallon, which is 180,000. I'm going to take that from my production cost of 300,000, and I get 120 for my cost of goods sold. So in this case, we break even. We have revenues of 120, cost of goods sold of 120. So I have 0 for my gross margin and 0 for my gross margin percentage. Net realizable value method. In this method, it allocates joint costs to joint products produced during the accounting period on the basis of relative NRV. NRV equals final sales value minus separable cost. In many cases, products are processed beyond the split-off point to bring them to a marketable form or to increase their value above their selling price at the split-off point. The NRV method is typically used in preference to the sales value method or split-off method only when selling prices for one or more products at the split-off point do not exist. So in our example here, we see that the overview of the net realizable value method. Note how the cost of the further processing are taken into account with this method. So again, it's very similar to what we've had before, where we had joint cost of 400,000, and that's up to the time it leaves the cow itself through the processing to the split-off point. We have split-off point, and we're going to have 25,000 gallons of cream and 75,000 gallons of skim milk. To further process those cream into buttercream, it takes $280,000, and those $280,000 would produce 20,000 gallons of buttercream. To take the liquid skim to condensed milk, it's going to cost us $520,000, and we're going to take that 75,000 gallons of liquid skim and make it into 50 gallons of condensed milk. So in this case, what do we have? We have the joint cost of 400,000. We have the separable cost after the split off point to make it buttercream of 280,000. And then we have the condensed milk, which is 520,000. We didn't have any beginning inventory. We have production of 25,000 gallons of cream and 75,000 gallons of liquid skim, 20,000 of buttercream, and 50,000 of condensed milk. So we transfer for further processing the entire 25,000 and 75,000. We have sales of buttercream of 12,000 and condensed milk of 45,000, with the ending inventory of 8,000 and 5,000 respectively. The selling price per gallon for cream did not change. It's still $8. Liquid skim is $4, but if we make the cream into buttercream, we can have a selling price of $25 per gallon, which is an increase of $17 per gallon. And then the condensed milk, we have $22 per gallon, which is an increase of $18 per gallon. Now, in the chart below, we use the selling price information to calculate the final sales value, deduct separable costs, and determine the net realizable value at split off. This is what we weigh to allocate joint cost. And this is the example of 16-6 on page 641 in your book. So again, we have buttercream. We take the $20,000, the final sales value of 20,000 gallons of $25 per gallon, which is 500,000. We take the 50,000 gallons and multiply it by $22 per gallon for the condensed milk. So we have a total final sales value of $1.6 million. We deduct the separable cost, which is $280 for the buttercream and $520,000 for the condensed milk. Our net realizable value of the split off point is $220,000. We take the 500 minus the 280, get 220. We take the condensed milk, the 1.1 million minus the 520,000 and get 580 with a total net realizable value of 800,000. The weighted average on that, we take the 220 divided by 800, I get 0.275. The 580,000 divided by 800, and I get 0.725. So then I take the joint allocated costs, multiply the 400,000 by that 0.275 and 0.725. I get 110,000 and 290 respectively. So to get my production cost per gallon, I take the 110 and divide it by the 280,000, or add it to the 280, the two different costs, and I divide it by the 20,000 gallons and the 50,000 gallons that we produce. We produce. So for buttercream, I'm going to have $19.50 per gallon, and condensed milk, I'm going to have $16.20 per gallon. Now, in the second part of this, we have to determine what my cost of goods sold is. Take the revenue, so we sold 12,000 gallons of the buttercream and 45,000 gallons of the condensed milk. Take the 12,000 times 25, I get 300,000. Take the 45,000 times 22, I get the 990. Now, cost of goods sold, I'm going to take the 0.275, multiply it by the 400,000, I get 110. But if you look at we already figured that up here in part A. And then we get 290 for condensed milk. We're going to add the separable cost of 280 and 520. So production costs are 390 for buttercream and 810 for condensed milk. Then I take the ending inventory for buttercream. It was 8,000 gallons. Multiply it by the 1950 that we got in panel A. And then the 5,000 for condensed milk, mark times it the 1620 that we got in plate panel A. So for buttercream, my ending inventory is 156,000. My ending inventory for condensed milk is 81,000. So my cost of goods sold is 234 for buttercream and 729 for condensed milk, making my gross margin of 66,000. Take that, divide it by the 300,000, and I get 22% gross margin. And then for condensed milk, my gross margin is 261. Take that, divide it by 990, and I get 26.4%. The constant gross margin percentage NRV method allocates joint costs to joint products produced during the accounting period in such a way that each individual product achieves an identical gross margin percentage. The method works backwards in that the overall gross margin is computed first. Joint costs are calculated as a residual amount by subtracting the separable costs and gross margin from the final sales value. The constant gross margin percentage NRV method can be broken down into 3 steps. The first step is to compute the overall gross margin percentage. The second is to compute the total production costs for each product. And the third step is to compute the allocated joint costs. In this example, we see the 3 steps just discussed. The constant gross margin NRV method is the only method whereby products can receive negative allocation. This is Exhibit 16-7 on page 642 in your book. So in the first thing, we have the total gallons. We have final sales value of total production during the accounting period. We take the 20,000 gallons times $25 per gallon, and then we take the 50,000 gallons and multiply it by $22 per gallon. So we get 1.6 million. Deduct the joint or separable costs, which is the 400,000, the 280, and the 520. So my gross margin is 400,000. That is a 25%. So I take the 400,000 divided by 1.6 million, and I get the 25,000. Now in step 2, we take the 500,000 to 20,000 gallons of buttercream, multiply it by the 25, the 50 gallons by the 22, and I get 500,000 and 1.1 million. Deduct the gross margin using the overall gross margin percentage. So how do I do that? I take the 25% of 500,000 and 25% of 1.1 million, and I get 125 and 275. And so the total production costs are 375 for buttermilk and 825,000 for condensed milk. Step 3, we deduct the separable costs of 280 and 520. So joint cost allocated will be 95,000 for buttercream and 305,000 for condensed milk. In panel B, we again calculate the gross margin. First thing we do is 12,000 times the 25 and 45,000 times the 22. So we have 300,000 in buttercream and 990 in condensed milk. Our joint costs from panel A, which are going to be 95,000 and 305. Our separable costs of 280 and 520. So total production cost for buttercream is 375 and condensed milk is 825. Then we do the ending inventory. Now, how did we get that ending inventory number? In the notes below, we take the 375, which is the production cost, divided by 20,000, and that's how I got the $18.75 or 75 cents. For the condensed milk, we do the same thing. We're going to take the 825 divided by the 50,000 gallons that we produced, and I get $16.50 per gallon. So using those rates, I'm going to take the 8,000 gallons that we have left in inventory, multiply it by the 1875, and I get 150,000. And then I take the 1650 per gallon, multiply it by 5,000 gallons, I get 82.5. So my cost of goods sold is going to be 225 for buttermilk, and condensed milk is 725,500. Taking the gross margin is 75,000, which is the 375 minus the 225, and then the 247. And both of those are 25%. So remember, this gross margin is going to match what you find in panel A. When choosing an allocation method, consider the following. If selling price at the split-off is available, the sales value at split-off method is preferred, even if further processing is done. Reasons include best measure of benefit received, independent of further processing decisions, common allocation basis, and simplicity. If selling prices are not available, then the NRV method is the best alternative. Despite this, some firms choose not to allocate joint costs at all. In Chapter 11, we introduce the concepts of relevant revenues, which are expected for future revenues that differ among alternative courses of action, and relevant costs, which are expected future costs that differ among alternative courses of action. These concepts can be applied to decisions on whether a joint product or main product should be sold at the split-off point or processed further. In sell or process further decisions, joint costs are irrelevant. Joint products have been produced, and a prospective decision must be made to sell immediately or process further and sell later. Joint costs are considered sunk costs. Don't assume all separable costs and joint cost allocations are always incremental costs. Some separable costs may be fixed. Separable costs need to be evaluated for relevance and individuality. Some other issues to consider. The potential conflict between cost concept used for decision making and cost concept used for evaluating the performances of managers often arise when sell or process further decisions are being made. Firms should be wary of using the full cost of a joint product as the basis for making pricing decisions, because it has a potential lack of cause and effect relationship. Two methods for accounting for byproducts. We have the production method, which recognizes byproducts inventory as it is created and sales and cost at the time of the sale. And sales method, we recognize no byproduct inventory and recognizes only sales at the time of sales. Byproduct costs are not tracked separately. Total costs or total sales value of byproducts are usually low, but the byproducts in a joint production process can affect the allocation of joint costs. In this particular thing, we have a pictorial view of how byproducts, in this case wood chips, come about. This is Exhibit 16-6 on page 646 in your book. So we have the timber where we have cut down the tree, and then we sent it to processing, and all those costs dealing with that process is $250,000. At the split off point, we're going to be making fine grade lumber, which is 50,000 board feet, and then wood chips, which is 4,000 cubic feet of wood chips. Here we have the comparative income statement accounting for byproducts for which are two methods, for each of our two methods. You recall that under the sales method, byproducts are not inventoried. This is Exhibit 16-9 in your book on page 647. So the main product, we have 40,000 board feet at $6 per board foot of $240,000. The byproduct of 12,000 cubic, 1,200 cubic feet at $1 per cubic foot. In the production method, there is no revenues for that, but in the sales method, we account for that $1,200. So under the production method, we have $240,000 in revenues, and in the sales method, we have $241,200 worth of revenues. Our total cost of total manufacturing cost, which is up to the split off point of $250,000, and that's the same for both the production method and the sales method. Deduct the byproduct revenue of 40,000 cubic foot of $1. So I'm going to subtract that. So my net manufacturing cost for the production value method is $246,000, but we don't take that in consideration for the sales method, so it's still $250 for the sales method. Now we deduct the main product inventory. For the production value, we have $49,200. And how did we come up with that? We take the $10,000 and divide it by 50,000 times the net manufacturing costs. So that's 10,000 divided by 50,000 times 246, and we have 49,200. We do the same thing for the sales method, but we only do it by 250, so that's 50,000. So my cost of goods sold is $196,800 and $200,000 for the sales method. My gross margin is $43,200 for the production method, and sales method is $41,200. My percentage is $18,000 for the production method, and sales method is $1,701. Inventoriable cost is for the production method is both the main product of the lumber and the wood chips, but under the sales method, it's only the main product. How do we select the method to use to account for byproducts? Keep in mind the following. The production method is consistent with matching the principles and is the preferred method. The production method recognizes the byproducts inventory in the accounting period in which it is produced and simultaneously reduces the cost of manufacturing the main or joint products, thereby better matching revenues to expenses from selling the main product. The sales method is simpler, but it allows a firm to manage reported earnings by timing the sales of the byproducts. Some of the terms that you need to know, and I would do these separate and have them as part of your notes. The byproducts, the constant gross margin percentage, NRV method, joint costs, joint products, main product, net realizable value method, physical measure method, product, sales value, split off method, and the separable cost and split off point cost. If you have any questions about any of the information provided into this lecture, please do not hesitate to ask. And I will talk to you later. Thank you and have a great day.